Have you ever wondered what happens to your money over time? You earn it, you save it, but somehow, it doesn't seem to stretch as far as it used to. Why is that? Today, we're diving deep into the world of money, investing, and how you can make your money work for you. Stick around because by the end of this video, you'll have a clear roadmap to start your investing journey. What happens to my money over time? Have you noticed that your money doesn't buy as much as it used to? Let's start with the basics. Stop money from losing value over time. Inflation. It's a term we hear a lot, but what does it actually mean for your money? Simply put, inflation is the gradual increase in prices over time. This means that the $100 you have today won't buy you as much in 10 years. The purchasing power of your money decreases, making it seem like your money is losing value even though the number on your bank statement stays the same. So, how can you stop your money from losing value over time? One effective way is through investing. Investing is the act of allocating your money into assets with the expectation that its value will grow over time. This could be anything from stocks and bonds to real estate and commodities. The goal is to generate a return that outpaces inflation, thereby increasing your wealth. But before we dive into how to invest, let's tackle the fundamental question. How do I make money? Making money can come from various sources: earning a salary from your job, starting a business, or investing in assets that generate passive income. The key is to understand that while earning is essential, it's equally crucial to make your money grow. What is an investment? Now, let's define what an investment is. An investment is an asset or item acquired with the goal of generating income or appreciation. In finance, an investment is a monetary asset purchased with the idea that it will provide income in the future or be sold at a higher price for a profit. What are shares? One of the most common forms of investment is buying shares. Shares represent ownership in a company. When you buy a share, you're buying a small piece of that company. If the company does well, the value of your shares increases, and you can sell them for a profit. If the company pays dividends, you'll receive a portion of the profits as well. How do I buy a share? So, how do you buy a share? You can buy shares through a brokerage account. There are many online platforms where you can create an account, deposit money, and start purchasing shares of different companies. It's essential to choose a reputable broker that offers low fees and good customer service. How do I decide which shares to buy? But how do you decide which shares to buy? This requires some research. Look into the company's financial health, its industry position, future growth prospects, and any potential risks. Many investors use metrics like the price-to-earnings ratio, PE, earnings per share, EPS, and revenue growth to make informed decisions. What's an index fund? If researching individual stocks sounds too daunting, you might want to consider investing in index funds. An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific index, such as the S&P 500. Investing in index funds is a popular strategy because it provides diversification, reduces risk, and typically has lower fees compared to actively managed funds. Isn't investing risky? Yes, investing does come with risks. The market can be volatile, and the value of your investments can go up and down. However, history shows that over the long term, markets tend to grow. The key is to diversify your investments and have a long-term perspective. Don't put all your eggs in one basket, and don't panic during short-term market fluctuations. When should I get started? The best time to start investing is as soon as possible. The earlier you start, the more time your money has to grow through the power of compounding. Compounding is the process where the returns on your investments generate their own returns, leading to exponential growth over time. How much money do I need to get started? You don't need a lot of money to start investing. Many brokerage accounts allow you to start with as little as $100. The important thing is to start, even if it's with a small amount, and gradually increase your investments as you become more comfortable. How do I begin? 1. Educate yourself. Learn about different investment options and strategies. First, educating yourself is crucial. There are countless resources available online, including books, podcasts, and courses that can teach you the fundamentals of investing. Understanding concepts like asset allocation, risk tolerance, and portfolio management will empower you to make informed decisions. 2. Set financial goals. Determine what you're investing for: retirement, buying a house, etc. Setting financial goals helps you stay focused and disciplined. Are you saving for retirement, a down payment on a house, or your child's education? Knowing your objectives will help you choose the right investment strategy and time horizon. 3. Choose a brokerage. Open an account with a reputable broker. Choosing a brokerage involves some research. Look for one that offers a user-friendly platform, low fees, and a wide range of investment options. Some popular online brokers include Vanguard, Fidelity, and Charles Schwab. Start small. Begin with a small investment to get comfortable. When you start small, you can learn the ropes without risking a significant amount of money. Even a modest investment can help you get comfortable with the process of buying and selling assets. 5. Diversify. Spread your investments across different assets to reduce risk. Diversification is a risk management strategy that involves spreading your investments across different asset classes, such as stocks, bonds, and real estate. This helps reduce the impact of any single investment's poor performance on your overall portfolio. 6. Monitor and adjust. Regularly review your portfolio and make adjustments as needed. Monitoring and adjusting your portfolio is an ongoing process. Regularly review your investments to ensure they align with your financial goals and risk tolerance. Rebalance your portfolio as needed to maintain your desired asset allocation. Now, let's address a common concern: the fear of losing money. While no investment is without risk, there are ways to manage and mitigate those risks. Diversification, as mentioned earlier, is one of the most effective strategies. Additionally, having a long-term perspective can help you ride out market volatility. Remember, investing is not about timing the market, but about time in the market. It's also important to understand the difference between investing and speculation. Investing involves a thorough analysis of an asset's potential for growth and income, while speculation is more about trying to predict short-term market movements. Stick to a well-researched investment plan rather than chasing quick profits. Another tip is to automate your investments. Many brokerage accounts allow you to set up automatic contributions from your bank account. This approach, known as dollar-cost averaging, involves regularly investing a fixed amount of money, regardless of market conditions. Over time, this can reduce the impact of market volatility and help you build wealth steadily. As you gain more experience and confidence, you can explore more advanced investment strategies. For instance, you might look into dividend investing, where you focus on companies that pay regular dividends. These dividends can provide a steady income stream, which can be reinvested to buy more shares and compound your returns. You might also consider tax-advantaged accounts like individual retirement accounts, IRAs, or 401k plans. These accounts offer tax benefits that can enhance your investment returns. For example, contributions to a traditional IRA are tax-deductible, while Roth IRA contributions are made with after-tax dollars but grow tax-free. In conclusion, investing is a powerful tool for building wealth and securing your financial future. It's never too early or too late to start. By educating yourself, setting clear financial goals, choosing a reliable brokerage, starting small, diversifying your investments, and regularly monitoring your portfolio, you can make your money work for you. With that said, thanks for watching, and until next time, don't forget to subscribe, like, and share this video if you found it helpful. Happy investing!